Hey guys, Stock Saturday, and it's a flat week again for me. I'm back to underperforming, which is sort of unsurprising considering sort of my heavy mining positions and gold and silver. So yeah, sort of go into a little bit more detail on that a bit later on. But yeah, let's get into some earnings because the earnings have started. So a quick run through the REITs. I won't go sort of too much into detail because they all do kind of look a little bit poor with real estate at the moment. But Vichy came out with theirs, and the sort of summary was steady, basically. The dividend hasn't increased. Adjusted funds from operations increased 1 cent for the quarter, but that's sort of fairly steady. 53 cents, 51, 49, 48 back to June last year. So that's pretty good, up sort of 10, 11% year on year. And capital expenditures sort of not too bad compared to some other REITs. I did sell a digital realty trust sort of partly because they were sort of spending a huge amount of capital expenditure and sort of badging it up as growth from sort of a few different sources. I read that they were doing that, sort of looked into it, and they do seem to be right, as well as sort of huge amount of debt. Vichy do have an enormous amount of debt, but they're sort of saying it's because the deals were available at the time, and so they've taken on this debt. They didn't want to sort of sell shares for the entire lot, so yeah, they've done that. But they think these are long-term tenants, obviously. 41 years average lease period, so that's incredible, really. 100% occupancy. These sort of people are very unlikely to suddenly leave. Although they have got 50 properties now and 4 golf courses, getting a bit more into the golf. And yeah, it's sort of less properties than a lot of REITs would have, but they are sort of getting more into the smaller casinos and sort of outside of Vegas. So they're in 15 states and Canada. And yeah, looking for sort of more to develop, but it's basically sort of steady figures, not growing sort of too much, and the assets, the sort of real estate portfolio itself, sort of not really going up, but not sort of crashing as some commercial property is. So yeah, nothing too bad there. And you had American Tower come out with theirs. Again, sort of not looking all that good, really. Revenue and everything obviously up, but that's because they're still building. So come down to adjusted funds from operations per share. That is down 2%. So yeah, not great. We'd like to sort of at least see flat to slightly growing if things aren't going too well, but 2% down, not the end of the world. Dividends increasing, so they sort of held back a little bit on raising dividends over the years, so that's not too bad, but a huge amount of debt, which I don't particularly like. 5.3 times leverage ratio, which is an awful lot, but yeah, the sort of the plan is that this is a very long-term sort of tailwind, basically, with the 5G rollout. To come down to their capital expenditure, and they're spending a huge amount really on discretionary capital projects, as they call it. Not a huge amount of improvement, and yeah, that is including the construction of 3,500 to 4,500 sites globally. So guessing these are the sort of much smaller 5G towers. The 5G ones are a lot smaller, I believe, than the 4G ones, but you just have a lot more of them. So 4,500 sites globally. Obviously, they are an enormous REIT, certainly my biggest REIT. But yeah, so hopefully good times for these sort of in the future, but not now. Obviously, these are all sort of relatively small positions now compared to my other holdings, so yeah, that's fair enough. You got Stag Industrial, again, sort of fairly mediocre results, 0% funds from operation growth, not exactly great, but it is sort of more industrial and even sort of some commercial. They're sort of acquiring a small amount, sort of getting rid of a small amount. I think they are net getting rid of some, so they're sort of trying to sell off the less profitable and sort of properties that they don't really want as much. Yeah, you come down to their lease terms, they are sort of much smaller than you think someone like Vichy 41-year average lease. Stag's is sort of 4 years or so. So I guess they can sort of turn these around to a new customer relatively quickly. But yeah, 4 years, you would sort of ideally like something a little bit more than that. But yeah, it's sort of not really surprising on the balance sheet and the statements. Property portfolio slightly down, debt slightly up, and yeah, total shares outstanding slightly up because they're always sort of wanting to have something in the pipeline. So yeah, nothing too much to sort of read into there, but it's steady growth, sort of obviously flat this year, but steady growth for the future. Again, not a huge position, but one that I would sort of like to build up later on. And then the one I wasn't particularly looking forward to, Sylvania Platinum. I knew it was coming, knew it was obviously going to be fairly poor with the metal prices at the moment. I expect this isn't the worst of it as well. Prices have been sort of coming down in July, so unless they sort of rocket back up, then Q3 is going to be even worse than this, but yeah, they're still sort of surviving. Revenue down 13% because production was up reasonably well. They've sort of made some adjustments and improvements to the equipment in the last quarter from the sounds of it, which was pretty good. So production up sort of 6 to 7%. But the basket price was down 18%, and as I say, that has fallen quite considerably in the start of the third quarter. So unless that rockets up, it's going to get worse. So net profit down 49%. Obviously, the leverage of profit or price getting closer to your production cost makes a much bigger difference. 18%. Basket price means 49% net profit, and yeah, capital expenditures up as well. This was sort of planned maintenance and upgrades, and the cash balance has sort of dropped 13%. I think this included the dividend, so still profitable, and that cash balance still sort of goes up. They've also been doing quite a bit of buybacks from the looks of it in the last quarter. So yeah, nothing sort of too much there. The all-in cost has risen 15%, which isn't particularly good either. But yeah, they're still profitable, and I would say still reasonably good value as long as we can get some sort of renewed car demand and sort of maybe the big sort of trucks and heavy industrial vehicles, because they do use an awful lot of the PGMs and aren't looking to sort of switch to electric en masse anytime soon. So yeah, that would be a big help, but yeah, slight cause for concern, I guess, if we don't get that car demand and the sort of EV switch does continue at the pace it has been. And then Vale, not looking too bad, up on last quarter, down revenue certainly up on last quarter. Metals sort of not doing too bad, iron and copper in particular. Obviously down on last quarter the second quarter last year, because that was sort of a reasonably good period for iron and copper. So you got costs up quite a bit from last quarter, but sort of around about the same as second quarter last year. EBITDA sort of again down from last year, but slightly up on last quarter. The net income has sort of been thrown out by some sort of one-off costs. Nothing too horrendous. EBITDA sort of up from last quarter. So yeah, nothing too bad there. Just looking at their production, it's looking pretty good. Iron ore up quite a bit from last quarter. They had a bit of trouble last quarter, up on last year as well. And copper looking pretty good. They're expanding their copper side, have been for a while, which is good. Diversify sort of away a little bit from sort of being heavily iron ore. And yeah, that's been going really well. Sort of 51,000 tonnes last year, up to 63 last quarter, and then 74,000 this quarter. Look at their sort of growth expansion projects. It's sort of going reasonably well. They break it down, so they've got lots of iron ore expansion projects as well, but they do have sort of a couple of copper expansion projects, and this one sort of started in the second half of last year and has been sort of ramping up. So hopefully we'll get a full year of that, and yeah, that should be pretty good. 30 to 40,000 tonnes per year. So very nice. So you look at the profitability side, this still sort of isn't really changing a huge amount. The metals are sort of quite often moving in somewhat of a unison. Iron ore sort of still around 50% EBITDA margin. Nickel sort of not all that good, sort of 20% or so. Copper about 40%, which is good, and they're expanding the copper, so that's a nice little profit maker. And then others not at all. And they still have their money that they have to set aside for the accident not so long ago, but obviously that isn't forever. So yeah, not bad. So just looking at the news, there was quite a lot come out this month. You had the some PMIs come out on Monday. This is sort of the indication of various sort of economic sectors and sort of the overall for each economy. Europe sort of came out a little bit under expectations, so sort of again under 50 would be sort of indicating a slight contraction, and that was the sort of overall EU one was down. S&P US ones were sort of, the manufacturing side was better than expected, but still below 50, and the sort of composite one and the services one were both below expectations but above 50. So people seemed sort of reasonably happy with that. Then Wednesday you had the US home sales for June, worse than expected. And then in the evening, the rate rise, which was sort of telegraphed. It was 98% sure it was going to be, 5.5%, 0.25% rate rise, but it was more about the conference as always afterwards. And yeah, there wasn't a huge amount sort of said there. Basically, Powell just kept saying the job, isn't done yet. They may have to keep raising and that sort of thing. People asking him the same questions, trying to sort of get a response out of him. One thing he did sort of say is, you would stop hiking long before you get to 2% inflation, because of the lag of when you raise rates to the effect that it actually has. And he actually said that you would probably start cutting before you get to 2%. So yeah, I sort of took that to mean, they've got to be sort of nearly done, because core inflation sort of coming down. He's saying not only would you stop raising before you get to 2%, but you would actually start cutting. So, yeah, they've come from sort of 7 or 8% core inflation, I think they got to, maybe sort of 7%, down to 4%, and he's saying he would start cutting before they get to 2. So, unless inflation sort of either just stays steady there or continues back up, then yeah, you can expect a cut sort of maybe a little bit sooner. He's saying they won't get to 2% inflation all of next year, but I'm not sure I buy that. I think that's just talk, to be honest. Then Thursday, you had the EU follow the same, 0.25% rate increase. That was sort of fairly expected. And yeah, US jobs data still sort of below, unemployment below expectations. He basically had a load of US data sort of come out better than expected, sort of durable goods orders, sort of companies buying large equipment above expectations, sort of GDP, provisional GDP for Q2 well above expectations and above last quarter, so they're growing. Bit of a surprise there. Jobs data again, unemployment claims lower, and then yeah, on the Friday you had the core PCE and PCE data. So this is the Fed's sort of favourite measure of inflation. They don't mind the core inflation, core CPI, but they sort of say that they prefer core PCE year on year. This is why investing.com sort of has this as a 3-star importance. It did reiterate in the FOMC meeting in one of the questions that sort of headline CPI really isn't the thing to be looking at, and that headline CPI follows core CPI because it is sort of volatile, but over time would follow core. So obviously headline CPI has been hugely affected by oil price coming down, but it's come up in the last month. So yeah, basically they're expecting headline to be sort of closer to core again, I think. We'll see, obviously, whether that plays out, but the PCE one was, again, lower than expectations and much lower than last month. 0.5% down from last month, down to 4.1%, 0.2% on the monthly. So you take the last sort of few months, they are getting there. So portfolio-wise, I've sort of made a reasonable amount of moves. I sold off Alphabet on their earnings, all looking sort of pretty good, and they had a nice bump up, and I just sort of can't really see myself wanting to sort of hold too much big tech at the moment. It sort of seems, I think the Nasdaq sort of very overvalued. Obviously, while it carries on sort of going up, might go up for sort of another few months, then I'm missing out on some of this gain, but I'm quite happy to sort of leave that. Obviously have my heavily risky side on the crypto side, so I'm not all that keen to sort of have loads and loads of risk in the stock section as well. You take things like Meta platforms have sort of rocketed up well past where I sold them at. You just have to sort of accept that, fair enough. I do have some greens. Stellantis have sort of been rocketing up in the last week, up about 12%. This is before earnings, so yeah, not too sure what sort of people are seeing. I haven't seen any noticeable news come out from them. Process is up quite a bit as well, but that's been sort of up and down all over the place last sort of few weeks. 4.4% up on just the Friday. All of China seemed to be up, potentially their stimulus. So yeah, Tencent doing well, pushing them up. Taiwan Semiconductor sort of doing reasonably well. Broadcom still sort of hovering around $900, sort of keeps going up and down, very much up and down with FX as well. So I keep sort of getting a small gain, and then the pound gains, and that sort of comes down. So yeah, it's a constant battle, but interesting. And then the ISA side was a little bit more change, so I sold Alphabet off and put that cash into here. Nearly filled up the ISA now. I got about £1,200 left to go, which I think I probably should get just from dividends between now and April. So that's not too bad. I don't actually have to sell anything more to fill the ISA. But I did sort of take the opportunity to put that cash and sold off a little bit of the sort of money market fund. Not really a money market fund, but the overnight cap corporate bond sort of money market type fund. And yeah, I put that into split three ways between Coeur Mining, Equinox Gold, and Fortuna Silver. So these are sort of obviously becoming much larger positions now. Fortuna has moved above Stag Industrial. I need to reorder these, but yeah, the sort of thinking behind this is sort of gold and silver, or partly silver. I would say I'm more bullish on silver in particular. Because it's getting sort of huge use in solar panels and sort of going forward expected to get more and more use in electric vehicles and sort of various other industrial use, and the supply basically isn't going up. A sort of good deal of the silver supply is sort of as a byproduct of copper and sort of various other mines. So unless people want to mine more copper or find ways to mine more copper, then you're not going to get a sudden increase in silver supply, even if the price goes up. So it's somewhat inelastic, as they call it. I'm sort of a big fan of Francis Hunt, the market sniper, and he's been sort of suggesting over the next year or two that gold and silver could be both do a reasonable move upwards. So I'd sort of been buying the miners sort of on the basis that some of them have sort of had much lower, much reduced profits while they're sort of expanding, and the sort of capex money goes straight into lower net income. But these are sort of coming to the ends of their expansion. Equinox Gold have quite a big one, sort of finishing middle of next year, but then they should be getting towards sort of 1 million ounces of gold mined per year. And if we do get a reasonable move up in the gold price as well, then that would do exceptionally well. But I think even without a significant move up, just sort of returning to profitability once the mines are open or expanded, then that should sort of remind people, I think, how good value they are. Coeur Mining especially, they do sort of should be 320,000 ounces of gold and I think 10 million ounces of silver once their expansion is done. So I think there's a lot of potential there, and that's why I've been adding to them. As I say, even with just a moderate move up, if we start getting what Francis is suggesting, then yeah, they could sort of 3, 4, 5x, but you can't sort of pin all my hopes on that. But yeah, that is the bet. I'll probably sort of keep dripping into them and sort of spending some of the cash position. But yeah, see where we go. No changes in the IG ISA. Things still sort of moving around, similar to the others. Obviously, Clean Spark coming down a bit. Pan American sort of moving with the rest of the silver miners. And then Interactive Brokers, as I say, China stocks sort of had a really good day on Friday. Alibaba and Baidu sort of up 5%, and they're sort of been doing pretty well for the week. Baba over $100 now, so that's pretty good. And then I have put another, I don't think it's quite cleared yet, but I've put another £1,000 of cash into interactive brokers to be buying options with. Again, sort of on this gold and silver idea, I bought a couple more options on Coeur Mining and sort of basically run out of cash, so I thought I'll put another £1,000 in there, and these are sort of end of 2024 options. The Coeur Mining ones are end of 2025, so if we do get this great move up that people are predicting, then yeah, they could do exceptionally well. Pretty happy with my clean spark ones as well. I sort of haven't really been tempted to add to those, even though I think clean spark will do well. The options are quite expensive now, so yeah, that was that's sort of how things are going. Obviously, I'm underperforming with this this sort of gold and silver and Bitcoin thesis, and sort of not having the the big tech holdings that are going up. But yeah, I'm thinking sort of slightly longer term, hopefully for the sort of next year to 2 years. Hopefully this will play out well. So leave your thoughts in comments below. What you guys are buying or what you're doing well on. I'm sure people are doing well. So yeah, like and subscribe. See you soon.